ABC were three partners sharing profits and losses in the ratio of 2:2:1, and this was the balance sheet as at 31st December 2017. Capitals: A 30,000, B 20,000, C 5,000. Reserve fund 10,000, creditors 15,000, total 80,000. Building 40,000, cash 10,000, profit and loss account 5,000, furniture 20,000, joint life policy 5,000, total 80,000. C dies on 31st January 2018. Goodwill was valued at rupees 25,000, building was appreciated by 20%, furniture was depreciated by 10%. The firm had taken a joint life policy for rupees 100,000 on 15th January 2016 at 10,000 rupees per annum. The surrender values of the policy were 16/0/2017, 5,000 rupees, 2018, 11,000 rupees, 2019, 18,000 rupees. Last year's net profit of the firm was 12,000. As per agreement, interest on capital was provided at the rate of 12% per annum. C had withdrawn rupees 1,000 for personal use after 31st December 2017. Prepare C's account. So you must have noticed a new things in this question. Number one, joint life policy of rupees 5,000 is appearing in the balance sheet on asset side. It means one thing is clear, they have taken joint life policy and they are showing it on the asset side, means they have adopted asset method. You know, if there is joint life policy on the asset side, it means that is the surrender value of the policy. And number two, C has died not on the same date of balance sheet. He has died after 1 month, means on 31st January. So this is something extra you have to calculate for 1 month. And generally, when the partner dies after the balance sheet, you will be asked to prepare only deceased capital accounts, not the balance sheet or other partners' capital account. So let's move to C's capital account. On the basis of balance sheet, by balance BD 5,000 rupees, this is the opening balance for C, I mean to say on 1st January 2018. Then accumulated profit, so by reserve fund, you know C share is 1/5, so he will get the 1/5 of reserve fund accumulated profit, and that is 2,000, means 1/5 of 10,000. Then accumulated loss on debit side to profit and loss account, that is 1/5 of 5,000, that is 1,000. Then we shall move to revaluation account. We have not been asked to prepare revaluation account, but I strongly recommend you should prepare revaluation account in the working notes. So go to the page of working notes and be careful, your working notes should be very neat and clean, because the marks are given not only on the basis of C's capital. Your working notes will also be considered how you calculated all the things. So prepare revaluation account by building 8,000, that is 20% of 40,000, and then to furniture 2,000, that is 10% of 20,000. So to profit transfer to capital accounts A, B, C, 2,400, 2,400 and 1,200. And in the outer column 6,000 rupees. Total on both sides 8,000 rupees. So C's share is 1,200. This is the profit. You know, profit always goes to credit of capital account. So on the capital account, on the credit side, by revaluation account 1,200. Then the treatment of goodwill. You know, the goodwill is 25,000. So 1/5 of 25,000 will be 5,000. So C must get the credit of rupees 5,000. So there are 2 or 3 options. You can write down by goodwill 5,000, or you can write down by A's capital, by B's capital 2,500, 2,500, because this is only the capital account, so you have got the liberty to give any treatment. So in this question I am going to write down by A's capital and by B's capital. This is in the gaining ratio. And after goodwill, we have to settle joint life policy. You know, in joint life policy, asset method, you know it very well how to prepare joint life policy account. So come to the working notes. On 1st January 2018, to balance BD 5,000 rupees. This figure has been taken from the balance sheet asset side, because last year the closing balance in balance sheet was 5,000. Next year it will become the opening balance of joint life policy. Be careful, joint life policy is a personal account in this question. And then on 15th of January 2018, to bank rupees 10,000, because now we have to record all the activities of 1 month. Agreement was made on 15th of January 2016. It means the annual premium will be paid on every 15th of January. So that's why we have paid the premium to bank 10,000, because annual premium is rupees 10,000. Then on 31st January 2018, C died. You know, the moment the partner dies, the policy amount becomes due from the insurance company. So write down by insurance company 100,000 or 1 lakh. And on the date of death, joint life policy account is closed. So there is a balancing figure on the debit side of 85,000 rupees. This is the gain for the firm, and this gain will be transferred directly to ABC. So to balance transfer to A's capital, B's capital and C's capital in the inner column 34,000, 34,000 and 17,000, and in the outer column 85,000, total on both sides 100,000. So in this way we can see that the deceased partner C will get 17,000, means he will get the credit of rupees 17,000. So come back to the C's capital account, by joint life policy 17,000 on the credit side of capital account. Now if you look at the question, last year net profit was 12,000. It's quite confusing for us and new things what we have to do with the last year profit. Number 2, interest on capital is provided at 12%. So one thing is clear, C has worked for 1 month in the firm, so he is entitled to 12% interest on capital for 1 month. And secondly, he had taken 1,000 for personal use from the firm. These are the drawings, and these drawings must be noted down in the capital. So come to the capital account, 2 drawings, rupees 1,000. In this question, C has died after 1 month. So as per law, he is entitled to get 1 month claim, and as per law, he can get the profit for 1 month, interest on capital if it is agreement, salary for 1 month if he is entitled, commission for 1 month if he is entitled, and he must pay interest on drawings for 1 month if this provision is in the agreement. So let's create a table, and you must memorize it. I strongly suggest you to write down for 3 or 4 times in your rough notebook so that you can remember it. And 1 month claim will be equal to net profit plus interest on capital plus salary plus commission minus interest on drawings. Net profit, how can we give him 1 month net profit? Because on 31st January we cannot prepare income statement, but we have to pay net profit for 1 month. For this situation, generally provision is made in their partnership agreement. If the agreement is silent about the profit, in that situation last year profit is taken as current year profit. So last year profit was 12,000. So we are going to assume that this year profit will be 12,000. So he is entitled to 1 month profit and 1/5 share. So that will be equal to 12,000 into 1 by 12 into 1 by 5. That is equal to 200 rupees. So as per our table, net profit is 200. Interest on capital for 1 month. His last capital was 5,000. So we have to calculate interest on capital at the rate of 12% for 1 month, because in their agreement interest on capital was 12%. So that will be 5,000 into 1 by 12 into 12 upon 100, that is equal to 50 rupees. So plus interest on capital will be 50 rupees, plus salary, that will be nil, because there is no provision of salary in their agreement. We have not been told about the salary as per question. It means no partner is entitled to any salary. Then plus commission. Commission can be for sales, commission can be for profit, commission can be for extra work, for anything. But the question is not mentioning anything about the commission. It means the commission will be 0. So total is 250 minus interest on drawings. As per agreement, there is no provision of interest on drawing. So that will be 0, 250 minus 0, 250. It means 1 month claim of C is equal to 250. C must get 250 for 1 month. That is profit plus interest on capital plus salary plus commission minus interest on drawings. For this claim, there are two options. Either you can write down profit and loss suspense account debit to C's capital if you draw the journal entry, or you can make the adjustment entry for 250 like goodwill, and this adjustment entry for 1 month claim is always passed in gaining ratio. So journal entry will be A's capital account debit, B's capital account debit to C's capital, 125, 125 and 250. In the narration, you will write down adjustment entry for 1 month claim of C. So there are two options. You can go for any option, and I strongly recommend you should follow your teacher. But in this question, I am going to use profit and loss suspense account. So on credit side, by profit and loss suspense account, and in the narration or inner column, you can write down 1 month claim. In this way, on the credit side, the total is 30,450, and on debit side, there are only two items, 1,000 and 1,000. So the balance is 28,450 on the debit side. This is the balancing figure. So this balance will be transferred to C's legal representatives account. So to C's legal representatives account, 28,450. In this way, you have completed C's capital account. It means in future, firm has to pay 28,450 to the legal representatives of C. So be careful in this question. The working notes should be clear on your answer sheet.